All right, so in this video, we'll be doing the objective test questions, okay? And you need to make sure that you are quite attentive while doing the objective test questions. And here we go. So starting with the question number 1. And this is the Kaplan kit, remember? Objective test question, section A from the Kaplan kit. IS 16 property plant equipment requires an asset to be measured at cost on its original recognition in the financial statements. Fine, initial measurement, is at cost. EW uses own staff assisted by the contractors when required to construct a new warehouse. So they have constructed the asset by themselves. Identify whether the costs listed below should be capitalized or expense out. And remember, because you will be giving the computer-based exam, you may have to tick or you may have to shuffle the right thing in the right column. So clearance of the site prior to the commencement of the construction. Yes, site clearance. Yes, we will be capitalizing that. Professional surveyor's fee for managing the construction work. Yes. EW's own staff wages for time spent working on construction. Yes, because this is the direct cost. A proportion of the EW's administration costs based on the staff time spent. Now, this is something administration. We talk about the variable overheads, and this is something fixed. So, no. And this should not be capitalized. So the first 3 should be capitalized, and the last one should be expensed out. Now, on July, question number 2, on July 2004, experimenter opened a chemical reprocessing plant. The plant was due to be active for 5 years until 30th June 2009, when it would be decommissioned. Okay, it will be decommissioned, restored after 5 years. Fine. At 1st July 2004, the cost of the decommissioning the plant were estimated to be 4 million in the 5-year time. So the future value is 4 million. Okay. Experimenter considers that the discount rate of 12% is appropriate. This is the cost of capital for the calculation of the present value, and the discount rate factor 12% for 5 years is 0.567. They have already calculated it. Let me just, otherwise you have to do with the formula. So how will be calculating that? So 4,000 is the amount that will be paid. So 4,000 into 0.567. So it will be, I have taken in the 000. So 4, because 4 million will be 4,000. So 4,000 into 0.567. It will give you 2268. Fine, 2268. And remember that 000 is in common. This is the present value. What is the total charge to the statement of profit or loss? Total charge. Okay, fine. Total charge. The total charge means the profit. They are talking about the profit or loss. So the total charge mean the unwinding plus the depreciation, because they are talking about the profit or loss. This thing will be capitalized. The entry will be debit asset, credit provision. But we have to unwind it, okay, because this was at 1st July, okay. Then when the 1 year has gone, we will unwind this thing. So this will be unwound. 2268 multiplied by 12%, if you remember. So we'll be multiplying it by this. Okay, it gives you 272.16, 12%. Okay, this is 12%. And now the depreciation. So this was unwinding, and now we will be having the depreciation. So depreciation will be 2268 divided by 5. It gives you 453.6. So 453.6 plus 272.16, it gives you 725 0.76. Yeah, this is the amount that should be charged to the profit or loss, and it will be your option B. So this was the MCQs number 2. Then an entity purchased property for 6 million on 1st July 20x3. The land element of the purchase was 1 million. The expected life of the building was 50 years and its residual value was nil. On 30th June 20x5, the property was revalued to the 7 million, of which the land element was 1.24 and the building element was 5.76. On 30th June 20x7, another 2 years, the property was sold for 6.8 million. What is the gain or loss on the disposal? So remember one thing, that you first of all, you need to take the cost and you take the accumulated depreciation. It gives you the carrying value. So the total value of the property was 6 million. So the land element was 1 million, 1,000. And the building element was obviously 5,000. So the total was 6,000. Then they revalued it on 30th June 2005 after 2 years. So 5,000 divided by 50 multiply by 2. So because land is not depreciated, 5,000 divided by 50 into 2. So it will give you 200. So the accumulated depreciation of the land is nil. The building is 200. The carrying value is 4,800. Now the revalued amount. So they revalued it, and on 30 June, the property was revalued 7 million. The land was 1.24, 1240, and the building element was 5760. Okay, so this will give you 7,000. That means the gain is 1,000. And if you see here, the gain is 240. And here 5760 minus 4,800, it will give you 960. Okay, so 960. Okay, so this was, sorry, this was actually 200 was the depreciation. This should be 5,800. Yeah, and this should be the difference is 1,200. Okay. Now, you remember the principle that once the revaluation is done, depreciation should be charged on the revalued amount and remaining useful life. So that again, the depreciation will be for 2 years, but the land is not depreciated, and the building element is 5760. Now the life is 48 years because 2 years have been done, and we now need the carrying value at 30th June 2007, so we'll be multiplying it by 2. So 5760 divided by 48 multiply by 2, it gives you 240. Okay, so this will be 1240, and the element will be 5760 minus 240. It will be 5520. And when you total it, it will be plus 5520 plus 1240. It will be 6760. Now we have done all this thing in order to calculate the carrying value at the disposal date. So we have calculated the carrying value at 30 June 20x7. Now the carrying value is 6760. And now we will be comparing that with the proceeds. So the proceeds were 6.8 million. That means 6,800. So the carrying value was 6760. The proceeds are 1,600. So the gain is for 40. So this is the A option. Now we have done all this thing to calculate the carrying value, and this carrying value is then compared to the proceeds, and it gives you the 40,000 gain. Now the MCQ is number 4. A manufacturing entity receives a grant of 1 million towards the purchase of a machine on 1st January 20x3. Okay, so 1 million for the purchase of machine. So this is capital grant, okay? Capital grant. The grant will be repayable if the entity sells the asset within 4 years, which it does not intend to do. The asset has a useful life of 5 years. Now remember one thing, that the grant should be released over the life of the asset, not on the possibility of that they may sold in 4-year time, which they are saying they do not intend to do that. So based on the intention, they cannot depreciate on 4 years. Okay, so the government said if you sold within 4 years, you will be paying it back, and they say we are not going to do that. So that means it should be depreciated over the 5 years. What is the deferred income liability? Remember that thing when you purchase the asset. What was the double entry? So debit asset, credit cash. When you receive the grant, debit cash, credit deferred income. Okay, so debit cash 1,000 and credit deferred income 1,000, and this deferred income will be released systematically. So deferred income debit, profit or loss credit systematically. So they receive the grant on 1st January 20x3, and the year end is 30th June 20x3. That means 6 months. So what we'll be doing, 1,000 divide by 5 into 6 by 12. So 1,000 divide by 5 multiply by 6 divide by 12. It gives you 100. Now 100 of the grant will be released. That means the total balance of the deferred income was 1,000. 100 is released. Now the remaining balance at 30 June will be 900. Okay, so this is how you calculate the things. Okay, clear? MCQ is number 4. Now on 1st January 20x1, state received 1 million from the local government on the condition that they employ at least 100 staff each year for the next 4 years. So revenue grant. Due to an economic downturn and reduced consumer demand on 1st January 20x2, that means right after 1 year, state no longer needed to employ any more staff, and the condition of the grant required full repayment. What should be recorded in the financial statement? So you remember the revenue grant. Once we receive the grant, debit cash, credit deferred income. So 1,000, 1,000. When the 1 year was passed, they have met the condition of 1 year, so they will be releasing the grant, debit deferred income, credit profit or loss, and the condition were 4 years. So 1,000 divided by 4, that means 250. 250 has been released. Now the remaining balance, which is 750, is known as unamortized deferred income. What will be done? We have already studied that. Okay, what will be done? Now they have to repay, so they will be de-recognizing the deferred income of 750. They will be recognizing 250, which have been charged as income in the profit or loss, and credit will go to the provision, 1,000. So what should be recorded in the financial statements on 1st January 20x2? So what they're going to do, reduce deferred income balance by 750. Yeah, but not only that. Reduce deferred income by 750 and recognizes the loss of 250. Yes. So this is their option B. Which of the following properties owned by Scoop would be classified as an investment property? Remember, investment property held for capital appreciation and to earn rentals, and those should not be used in the ordinary course of business. A property that had been leased to a tenant but which is no longer required and is now being held for resale. So this is IFRS 5, non-current asset held for sale. Okay, land purchase for the investment potential. Planning permission has not been obtained from building construction of any kind. Land purchase for investment potential. Yeah, this one. A new office building is IS16. A stately home used for executive training, this is IS16. So B option. During a current year, an entity had in place of 1 million of 6% loan and 2 million of 8% loan. Okay, they have two loans that in multiple borrowings. So you need to calculate the weighted average cost of capital. Oh, I have written one more C. It constructed a new factory which cost 6 lakh, and this was funded out of the existing loan. The factory took 8 months to complete. To the nearest thousand, what borrowing cost should be capitalized? Now, first of all, you need to calculate the weighted average cost of capital. So that will be calculated as 1 million, 1,000 into 6% plus 2 million, that means 2,000 into 8%, divide by 3 million. So you need to simplify it. 1,000, let me just calculate on my calculator. Okay, it will be 60 plus 160, 220 divided by, it will be 3,000, 3,000. So it gives you 7.3%. This is the WACC. And now now we're going to calculate the capitalized amount. So 6,000 was spent. It constructed a new factory which cost 6,000, and this was funded out of the existing loan finance. So 6,000 multiplied by 7.3%. But this is for the whole year. It will be months by 12. So what we're going to do is 6,000 multiplied by 7.3%. Multiply by 8 divided by 12. Okay. So it should be, it's giving me 292. Okay, so the 000, 292, okay, it will be 29,000. Yeah, so you have to calculate in the nearest thousand. So nearest thousand will be 29,000. So this is question number 7. Now, which of the following statement is correct? Statement number 1, if the revaluation model is used for the property, plant, and equipment, revaluation must subsequently be made with sufficient regularity to ensure that the carrying amount does not differ materially from the fair value at reporting date. Yes, it is true. When an item of property, plant, equipment is revalued, there is no requirement of the entire class being revalued. This is false. Straight away. Which two of the following items could be capitalized within the initial carrying amount of an item of plant? Cost of transporting the plant to the factory, yes. Cost of installing a new power supply, yeah, obviously yes. A deduction to reflect, no, net realizable value is deducted from the cost. A cost of 3-year maintenance agreement, no, this is revenue expenditure. The cost of training, no, training cannot be capitalized. So A and B. Tibet acquired a new office building on 1st October 20x4. Its initial carrying amount consisted of land, building structure, air conditioning, and this is the cost. The estimated lives of the building structure and their conditioning systems are 25 years and 10 years respectively. When the air conditioning system is due for replacement, it is estimated that the old system will be dismantled and sold for 5 lakh. This is the scrap value. Depreciation is time apportioned where appropriate. Fine. Pro rata. At what amount will be the office building shown in the Tibet statement of financial position at 31st March? So this was 1st October 20x4, and we have to go till 31st March. So October, November, December, January, February, March. Okay, 6 months. Fine. Now, let's do it. Land will not be depreciated, so straight away. Then you have the building. Now you need to calculate it. Building was 10,000. Building's life is 25 years. Okay, so you multiply by 6 by 12. So 10,000 divided by 25, multiply by 6 divided by 12. It gives you 200. So 10,000 minus 200. It will be recorded at 9,800. Then you have air conditioning system. Okay, the cost is 4,000 and the scrap value is 500. Okay, divide by 10, multiply by 6 by 12. So 4,000 minus its scrap value. Okay, so divide by 10, multiply by 6, divide by 12. It gives you 175. So 4,000 minus 175. It gives you 3,825. Now you're going to total it. 3,825 plus 9,800 plus 2,000. It gives you 15,625. And let's see. 15,625. This is option number A. Okay. Now moving further. The following trial balance extract relates to a property which is owned by Wheaton at 1st April 20x4. Property at cost 12,000. Remember, it has the original life of 20 years. And accumulated depreciation was 3,600. So when you deduct the cost and accumulated depreciation, it gives you the carrying value. On 1st October 20x4, following a sustained increase in property prices, Wheaton revalued its property. Remember one thing that we have said, when you are doing the revaluation, you have to calculate the carrying value at revaluation date. So the cost is 12,000. Accumulated depreciation is 3,600. So 12,000 minus 3,600, it gives you 8,400. Now we need the carrying value at revaluation date. So what we will be doing, we will be deducting the depreciation. Okay. But remember one thing, that here is a technique. 12,000 was the cost. The life was 20 years. So if you see 12,000 divided by 20, it gives you 600 per year depreciation. The total accumulated depreciation is 3,600. Divide by 600, that means 6 years have been passed. Remember, in the final accounts, you will be having the same thing, and the examiner is going to test this technique. So the 6 years have been passed, and as at 1st April 20x4, 14 years are remaining. Okay, now you need the carrying value at 1st October. So what you will be doing, April, May, June, July, August, September. 6 months. You will be charging the depreciation of 6 months. Okay, so that will be simply, what will be that? Yeah, so 12,000, it will be 600 multiplied by 6 by 12. That will be 300, and it will give you 8,100. So 8,100 was the carrying value, right? at revaluation date, and now this reaches to 10,800. So the revalued amount is 10,800. So what should be the gain? 10,800 minus 8,100. It gives you the gain of 2,700. Now the depreciation should be charged on the revalued amount and remaining useful life. Now the revalued amount is 10,800. The remaining useful life is now 13.5 years, because as at 1st April it was 14 years. Now further 6 months have passed and now it is 13.5. And now in this year we'll be charging the depreciation of 6 months, because 6 months have been charged and now the other 6 months till 31st March. So 10,800 divided by 13.5. Okay, multiply by 6 by 12. It gives you 400. So 400, what they said, what will be the depreciation for the whole year? So the depreciation will be 400 for the other 6 months, 300 for the first 6 months. Now the total depreciation will be 700. So this is C. So this was an important point, and you need to focus on it. This MCQs particularly, because in the exam you will be having the MCQs like this. Which of the following statement about IS 20 are true? The government grant related to the purchase of an asset must be deducted from the carrying amount of the asset. Must be deducted. No, this is actually a policy. You can deduct that. It's not compulsory. So this is not true. A government grant related to the purchase of an asset should be recognized in the profit or loss over the life of asset. Yes, we have done this MCQs. Free marketing advice provided by the government department is excluded from the definition of government grant. Yeah, advice is not something monetary, so how you can record that? Fine, this is true because that is excluded. Any required payment of a government grant received in earlier reporting period is treated as prior adjustment. No. If you receive a grant for already incurred expense, that should be recorded prospectively rather than retrospectively. So this is false. So B and C are true. Okay. Smithson purchased a new building with a 50-year life of for 10 million on 1st January 20X3. On 30th June 20X5, Smithson company moved out of the building and rented it out to the third parties. So it was IS-16, but on 30th June they rented it out and gave it the rent. Now that is IS-40. So when you transfer the property from IS-16 to IS-40, you remember the treatment. You need to revalue it at the transfer date. Smithson Company uses the fair value method for investment properties. At 30th June, the fair value was 11 million, and at 31st December 2005, it was 11.5. What is the total net amount to be recorded in the profit or loss in respect of this? So first of all, we need to calculate the carrying value. Okay, it was 10 million, so 10,000, and the life was 50 years. So 10,000 divided by 50. It gives you 200. And okay, 1st January 20X3 and 20X4, then it is 20X5, and then further 6 months. So 200 plus 200 and then plus 100. So it makes 500. So 10,000 minus 500, it will be 9,500. So the carrying value at the transfer date was 9,500, okay? And the fair value at transfer date was 11 million. So 11,000. Now the difference is 1,500, which will be recognized in the other comprehensive income. Okay. Then it is transferred to the IS-40. Now subsequent gain will be recorded in the profit or loss. Now it is revalued further 11,500. Now this 500 will be recorded in the profit or loss. They said, what is the net amount to be recorded? So this 500 was the gain, and there was the depreciation of 100 as well for 6 months. So the net income that will be recorded will be 500 gain and 100 expense. So it will be 400. Now, Gilbert took out a 7.5 billion 10% loan on 1st January 2006 to build a new warehouse during the year. Construction of the warehouse began on 1st February. That means we'll capitalize from 1st February rather than 1st January, and was completed on 30th November. As not all the funds were needed, Gilbert invested 2 million in 4.5% bonds from 1st January. So remember, any investment income which is earned during the construction period should be netted off. This was the rule. So first of all, we will be calculating the finance cost. Okay, it was 7,500. Okay, 7,500. Fine. Now, if we take the 7,500 multiply by 10% and multiply by, okay, February, March, April, May, June, July, August, September, October, November. So these are 9 months. February, March, April, May, June, July, August, September, October, November. No, these are 10 months. Okay, 10 months. So multiply by 10, divide by 12. 7,500 into 0.1 into 10, divide by 12. It gives you 625. So 625,000. Okay. And then you have this 2,002,000 into 4.5%. And now from 1st January, but we will not take the January because January was not in the construction period. So February, March, April. So we'll be multiplying it by 3 by 12. So it will be 2,000 into 4.5% multiply by 3 divided by 12. It will be 22,500. Now this amount should be capitalized. 6,25,000 minus 22,500. Sorry, it will be 602500. 6025. This should be capitalized. Okay, in this video we are done with 14 MCQs. In the next video we'll be doing further.